Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to talk to you about asset allocation and how to think about allocating your money across different types of investments or asset classes. This is part one of a multi-part series on asset allocation, and my goal is to ultimately equip you with all of the information you need to decide what asset allocation makes sense for you. The problem with everything we're taught around asset allocation is that most of it doesn't take into account the full picture. Methods like the 60-40 method, where they say put 60% in stocks and 40% in bonds, really don't take into account the fact that there are a lot of different asset classes out there besides just stocks and bonds. I personally think that a lot of the asset classes beyond stocks and bonds are much better investments that you can make, and you certainly don't want to have a situation where you have 100% of your money in the stock market or 100% of your money in stocks and bonds. That is not diversified, not even close. In this video, I'm going to explain to you why asset allocation matters, and it might be thoughts beyond just what you're traditionally taught as far as why you need to diversify the investments you make. I'm also going to share with you some outside the box thoughts as far as how I approach asset allocation. And at the end, I'll introduce you to the conceptual framework about how to do asset allocation. So let's go ahead and just start with why does it matter? Why do we need to think about asset allocation, and why do we need to invest across different types of asset classes and investments? So this first one is what we all know, right? We want to protect against the risk of market downturns. The idea here is that if one market goes down, another might. So if you have the stock market and say the stock market tanks, maybe the real estate market's still okay, or vice versa. So the idea is if you spread it across different types of asset classes or different types of investments, that you can somehow shield yourself against a market downturn. This is also true within the stock market. I know a lot of people do stock picking, like financial advisors. And the idea is that if something happens to one industry, maybe my Coca-Cola and Apple shares will still be okay. So you're trying to protect against market downturns in the sense that you're going to have a big drop in all the money that you have because you're fully invested in one small sector or niche or whatever it is. You also want to wonder about asset allocation because if you want to diversify the types of risk you're exposed to. So there's risk beyond just market downturns. There's all different types of risk. So you've got risk that the Federal Reserve is going to do something crazy. You've got risk that, we're going to keep printing money and create inflation, or that we're going to, have to raise interest rates like we did a few years ago. You've got risk that Jamie Dimon or, other bank CEOs are going to predict a recession that's coming that never happens. So what you also have other types of risk that are beyond just what happens to the stock market. You've got weather and storms and what that can mean for real estate, what that can mean for certain sectors like the insurance industry. So you've got, different types of law changes, like federal law changes could really impact the stock market, but state law changes could really impact your real estate if you own, real estate properties in that state. So there's all different types of risk that you could be exposed to by owning assets, and you want to diversify those types of risk that you're exposed to. So it's beyond just market downturns. It's really the type of risk and the category of risk that you have exposure to from that asset class. You want to limit geographic risk. So things like, you wouldn't want to own all your real estate properties in Georgia, for example. You want to diversify where you own real estate, where your, other assets are. If you have businesses, you might want to diversify the location of those businesses in some cases. You wouldn't want 100% of your net worth in a construction company in one state. So you've got all different ways that you want to make sure that you are limiting geographic risk by diversifying where you own assets and where those assets operate. Same with sector risk. So you wouldn't want to own businesses, all in one sector. Even if you're investing in the stock market, you wouldn't want to have, all your money in tech stocks, for example, because there can always be things that, come and, create big issues for a sector itself. You also, I think, especially these days with AI and all the advancements around technology lately, is that you could have obsolete risk. You could have a situation where some AI comes out and just completely makes an entire industry obsolete. So you want to make sure you're diversifying against that potential risk. You also want the ability to capture big returns. So these two kind of go hand in hand. You're diversifying not only to limit your downside exposure, but you want to be able to maximize your upside exposure as well. So you want to make sure you do have some investments that could have big gains to, make sure you're diversifying the ability to capture upside risk as well. This also goes hand in hand with emerging industry. So I don't think this gets talked about enough, but you want to make sure that you have investments in categories that can, be able to take advantage of emerging technologies or revolutions. So things like blockchain technology, things like this AI boom that we're going through right now, internet boom. So I personally think this is one of the most important reasons for asset allocation. You wouldn't want 100% of your net worth invested in the future of AI. There can always be issues. We know we saw in the 90s with the web boom that there were a lot of people who lost a lot of money. But to not capture, or invest in those types of revolutions, I think is very dangerous and risky, because you're just missing out on the biggest potential for wealth accumulation during your lifetime. So personally, my own view is that if you're not investing in blockchain and AI right now, you're missing out on one of the biggest vast accumulations of wealth and changes that we're going to have in our lifetime. So I'm not telling you what to invest in, but I'm just explaining to you why you want to make sure you diversify and do have some investments that can allow you to take advantage of these types of things. You also want to diversify timing of investments and returns. So you don't want to invest in something that's going to always, pay out at this point and give distributions at this point in the investment. You want to make investments at different times. So you don't want to put all your money into different types of investments today. You want to make sure you're spreading that out over time and you're actually making those investments at different times. And you want investments that kick off returns at different times. You don't want all of your investments to be 5 to 10 year trajectories. Real estate types investments have very different time periods and time horizons than private equity and venture capital. So you also want to make sure you're diversifying the timing of these investments and the timing of when those returns are expected. The last thing I'll mention is that you want to diversify income streams. So you never want a situation where you've got 100% of your money or a large portion of your money coming from one stream of income. And that can mean a W-2 job. I think a lot of people make this mistake where, 90% of their money is coming from their W-2 job, where you basically are the asset yourself and you've got to be in the grind in order for that income stream to continue. Same happens with business owners. I see this happen a lot where, you can own one business and diversify your income streams within that business, but also you can own multiple businesses and have multiple different types of uncorrelated income streams. So I think you want to make sure you're diversifying streams of income from how you earn money as well as to, if you're investing in the stock market, you don't want all your money coming from these dividends. You want different types of income streams. You want distributions from real estate funds. You want distributions from private equity funds when they sell portfolio companies. So you want to diversify the types of income streams that you're getting as well. And that's very important to asset protection. I do want to share a few outside the box thoughts on asset protection. So I think this is very important when you're thinking about this conceptually. You cannot just employ one size fits all approaches, and those just don't work. It doesn't make sense that every single person who's in my age bracket should be doing the 60-40 method where stocks and bonds. That makes absolutely no sense. My risk appetite is drastically different than other people's. The amount of net worth I have is going to be different. There's a lot of people who have a lot more money than me, and there's a lot of people who don't have as much money than me. There's a lot of people who have different risks that they're exposed to. Maybe they're a W-2 full-time employee, which I think is very risky. So you've got all different types of risk appetite, objectives. We all have different types of objectives. I live in New York City. There's people who have much different types of lifestyles and different types of expenses than I would when they live outside, in smaller suburban areas. So this idea that there's a one size fits all approach just makes absolutely no sense. Also, the amount of money you have is going to very much drive the types of investments you can make. So the idea that someone who's a qualified purchaser would have the same asset allocation as someone who is, still just starting their career, building wealth, that makes absolutely no sense, because the types of investments available to a qualified purchaser are drastically different and much wider than someone who's not at that level yet. So again, any one size fits all approach. I think there's some very smart people out there who talk about this. I've read everything Ray Dalio's put out. I'm a big fan of his. But this idea that, some strategy that Ray Dalio says is applicable to everybody in my age range just makes no sense. I'm not saying he doesn't know what he's doing, but I'm just saying you've got to understand asset allocation. You've got to understand your own objectives, your own risk appetite, what's going to afford you the lifestyle you want, and be able to make your own decisions. Also, asset allocation is not about limiting downside risk. I think this is a big misconception. Investments that go down are bad investments. I don't care where you made that investment. So if you're thinking that, you're going to have 100% of your money in the stock market and you're going to buy large cap companies thinking that, most of these will go up, but a few might be losers, you should not be investing in those losers. Investments that go down are bad investments, and you shouldn't be making those investments in the first place. So this idea that asset allocation is to limit downside risk from making a bad investment, I think is just really the wrong way to think about it. It's really about diversifying your investments. And I would think more about ability to capture upside potential than downside potential, because if there's an investment that I think could lose money, then I'm not making it. It doesn't make sense. Also, I've talked a lot about this in this video. There are investments in, a lot of different asset classes that you can make. It doesn't matter how much money you have. So don't just think that, you can invest in the stock market and diversify yourself. Investing in Coca-Cola, Apple, Tesla, these people that have these, if you pull up any portfolio that a financial advisor, manages, you can almost always, you'll see the same exact, companies in those portfolios. That is not diversification. Owning Coca-Cola shares, owning Nike shares, that's not diversification. You are still investing in one asset class, and that's the stock market. So, again, remember, there are a lot of different investments that you can make in a lot of different asset classes outside the stock market. So don't just have the flawed thinking that I'm diversified because I own a lot of different stocks. I think that's a big misconception out there. And I also think it's very dangerous to someone who really wants to build wealth. Also, there is no magic allocation percentage. I know a lot of people want to know, what should I put in real estate? What should I put in stocks? What should I put in bonds? There is no magic number to that. A lot of it is different. Again, as I go back, there's no one size fits all approach, but you just want to make good investments. Yes, I wouldn't want, too much of a percentage of my net worth in one asset class as opposed to the other, but you can't just say 10% in real estate, 20% in stock market. That just makes no sense. Also, it depends on what strategies you're employing, what tax planning you're doing. A lot of that is going to dictate how you invest in different asset classes. So don't just sit here and, watch a video thinking that I'm going to tell you the magic percentage. There is no magic percentage. Anyone who tells you these are the percentages you should use, it just, in my opinion, that's garbage. Like, you can't just have this one size fits all approach to everyone. There has to be more customized thinking about risk appetite, objectives, expenses, what your ultimate goals are before you can really decide how much you should invest in one asset class as opposed to other. Also, this will make more sense after I talk to you about the conceptual process for doing asset allocation, but some investments, when we get to step 2, and I'll explain to you what step 2 is in a minute, but some investments will actually do some asset diversification for you in and of themselves. So what that means is that index funds, if I invest in an S&P 500 index fund, that is one type of asset class. I'm investing in the stock market. So that's the asset class, but I am diversifying within that asset class by investing in the index fund because I'm capturing all of the returns and all the upside gain from the S&P 500. So, same as large private equity funds, they'll invest in a lot of different, portfolio companies themselves, and they're not usually going to target the same industry if it's a larger fund. Venture capital funds, they might be within one sector in some cases or focus on one type of strategy, but they are in a lot of cases, investing in a lot of different types of companies within that sector, within that strategy. Fund of funds. So watch out. There's an extra layer of fees here because you pay a fee at each fund level. But a fund of funds means you're diversifying because your fund is investing in different types of funds, and those funds are diversified themselves. So keep in mind that when you're thinking about asset allocation, that you could have investments that are helping you with the diversification within that asset class. So don't ever put 100% of your money in index funds. That in itself is not diversified, but you may be diversified within that asset class itself by investing in that index fund. So that'll make more sense once we go through the process as far as how to do that. So this is a 2-step approach. And in the next parts, I mentioned this is going to be a multi-part series. I'll explain to you this process in more detail. We're going to deep dive into each of these steps in separate videos themselves. But I just want to explain to you the conceptual framework. So there's 2 steps to doing asset allocation. First, you have to allocate across each asset class. So what's an asset class? Like the stock market, like real estate, like, private equity, like venture capital, like cryptocurrency. These are different asset classes. So to do that, you need to understand what are the different types of asset classes out there. It's not just stocks and bonds. There are a wide range of different types of asset classes. So to start with, you need to understand all the different types of asset classes that are available. And then within that, you need to understand what types of asset classes are available to you now. So as I mentioned, if you're a qualified purchaser, that means you've got more than 5 million of investable assets. That's not, everyone's not at that level yet. But the types of investments you can make as a qualified purchaser are, there's more asset classes available to them and different types of investments that they're eligible to make that you may not be able to make if you're not at that level yet. Same with the accredited investor hurdle. There's different types of investments they can make if you're an accredited investor that's not available to people who aren't. So you need to understand all the asset classes out there and all the asset classes available to you now where you are on your journey. Step 2 is that you need to, once you understand all the asset classes that are available and what you can invest in today, how you want to allocate within those asset classes. So there's kind of 2 levels of diversification that you need to do. Some people just think that, I'm going out and buying Bitcoin and that's my investment in crypto and that's my asset allocation there. Well, that's actually not diversified. Crypto is much broader than just Bitcoin. And, again, I don't give investment advice, but I own a lot of different cryptocurrencies within the umbrella of my crypto investment. So it's important that you don't just think that, investing in Bitcoin is covering that asset class. Once you get your asset class, you've got to then diversify within that asset class. So a good example of the way to think about this is step one. The asset class itself is real estate, but when you get to step two and allocate within the real estate asset class, there's all different types of investments you can make. Multifamily, single family, different industrial, medical, self-storage, mobile home parks. There's all different types of investments. They're very different. The risk that comes with those investments, the return trajectories, all different types, they work very differently. Investing in large apartment buildings is very different than going out and buying single family residences. So you need to understand that there's an additional layer to asset allocation where you are diversifying within that asset class. So you want to make sure that once you've decided the asset classes that are available to you and how you want to allocate your money across those asset classes, what types of investments within those classes are going to align with my objectives and my risk appetite. So don't forget the second step. That's very important. And as I mentioned, we're going to have other videos where I dive into these in more detail with you and help you understand, how each of these steps would work in detail and the different types of, I will go through the different types of asset classes that are available. And then I'll go, within each asset class, what are the different types of investments in those asset classes. So make sure you subscribe to the channel and stay tuned for those different series when those come out. Hopefully you found this video helpful. This is just part one of getting you started on thinking about asset allocation for, how you should allocate your money across investments in your wealth building journey.